You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from this ever-expanding, ever-exciting whirlwind known as the Options Insider Radio Network. I'm back from my vacation, back, and happy to be back in the hosting chair here on the old Volatility Views program. And of course, where can you find all the fun episodes of this program as well as every other program on the old network? Well, a lot of places you can do that. Of course, you can surf on over to theoptionsinsider.com. You can find all the episodes of all of our programs, find some unusual activity alerts. We do quite a few of those up there. Educational articles, analytical articles, breaking news from the options market, all that fun stuff available on our website. The episodes are also available wherever you find your finer audio programs online. Stitcher, Aha Mobile, iTunes, TuneIn Pro, wherever you go to get your files, we're there, as well as on mobile devices via our mobile app available for iOS, Android, and the Fire OS. You can, of course, instantly stream all of the many, many episodes, well over 100 now, of Volatility Views, as well as download them for offline listening if you're going to be traveling a bit on a train, on a plane. Well, maybe you want to download a few episodes to catch up on some stuff. And I love to see our listeners diving into the archives. We have someone writing in about those today. There is an extensive archive there, listeners, full of interviews with a lot of the great names and minds in the world of volatility. I encourage you, if you haven't checked it out, if you're new to the show, search through those archives a little bit and see who we chat with. They're pretty interesting. And of course, all that available via our mobile app, available for Android, iOS, and the Fire OS. All right, and joining me on the old program today, starting off with the man beaming in from somewhere east of here. I don't know if it's southeast or more directly east. He'll let us know himself. None other than Mr. Jared Woodard from BGC Partners. Jared, welcome back to the show, sir.
Oh, thanks. I'm so glad to be with you. I'm talking to you still from Virginia, and probably an episode or two from now from the heart of New York, and happy to do it wherever I am.
And well done last week, sir, in the big hosting chair. Kudos to you, sir.
Thanks. We managed to get through it.
It is quite the challenge, but it is fun once you get into the swing of it. All right, listeners, we are also joined from also to the east. Actually, this time to the northeast. I know where he is. He's in the great state of Maine, none other than the Rock Lobster himself, Mr. Andrew Giovinazzi from far and wide, Option Pit, Options Insider. He's everywhere these days. Mr. Rock Lobster, welcome back to the program, sir.
Always a pleasure. It's hard to get more east than I am.
Yeah, you're pretty
east.
east.
Actually, technically have to go down east from me.
You have to, I guess you can go over like Nova Scotia or one of those. That's about it.
Oh, they just started a ferry again.
Really?
Yeah, it's supposed to be pretty cool there. That's our family next summer vacation thingy. Going up there and hanging out with the Canucks.
But I guess, staying on the continental U.S., you're pretty much getting about as far east as it goes. You're right.
Pretty much. I mean, up the coast for me a little bit, and then you jog pretty much due east, and that's it. That's the end of the U.S.
Just shows the magic of the Options Insider Radio Network listeners, bringing in minds far and wide. No matter how far away they go, they can't hide from us here.
And how far out their mind is.
Yes, that's true too. All levels of out there here on the old network. All right, with the team assembled, it's time to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. You know the game by now. This is the portion of the show we break down the week that was. From a volatility perspective, perhaps not as exciting, not as scintillating of a week as the week when I was off, but still a lot to talk about this week. We did have a bit of activity, a bit of movement. We'll start, as we are wont to do, in the realm of the VIX cash. And we had a bit of a range this week in the VIX cash. Again, not as wide as we have seen in recent weeks, but still some decent movement, some decent vol, if you will, out there. VIX cash ranging from a low of about 14.69 earlier this week, all the way up to nearly 17.5, 17.3 to be precise. Also, some interesting relationships going on between what's going on out there in the VIX cash and VIX futures land. So a lot going on, a lot to discuss out there. Maybe we'll flip the script a bit, and Mr. Andrew, we'll start with you. What amongst all the different myriad activities going on out there in the volatility land and VIX cash land caught your eye this past week?
Me before Jared? I don't even know what to do with myself.
I'm mixing it all up.
Here.
I'm mixing it all up. It's all crazy this week.
The listeners won't be able to know what to do. You know what we had? This was the week of VIX futures trading for less than cash. Actually, just in our option pit chat and our pro chat, we just discussed kind of an arb for this trade. And, you know, you just don't see the cash hang this far over the futures or, you know, at least stay equal to it for like a whole week period when the vol's only 16, when VIX is only 16. You know, when it's 25 and everybody's losing their mind about government shutdowns and stuff like that, that's different. But, you know, this is slightly different. And it brings an interesting thought where truly the market is confused on what to do. My view has always been the closer the VIX futures are to the cash near term, the more confused people are. When they go in severe contango or when they go in severe backwardation, I think they're a little bit more confident on market either going up or down or having a big swing or something like that. But right now, I think everybody's like, I don't know what's going on. And, you know, we had a lot of crazy activity overnight in the VIX futures, huge buying and then selling. And I just think, you know, when I always just call it, there's the saber rattling market where when the U.S. normally goes in, when the bombs start dropping, the market usually flies and vol gets crushed. And I've been watching 2 Gulf Wars, like several small incursions, Bosnia, all that kind of stuff. You know, probably 4 or 5 little and big things happen. And 5 out of 5, markets rallied, vols came down. This is the first time I can remember where we actually sent some jets in. Maybe they're bombing. I don't know if the news is happening yet. You know, they hit these ISIS guys, and we don't really have that solid rally, that solid vol crush. So I think this is really like the market is in the show me the money phase with what's going on. And I think that's where the vol is going to hang this weekend. A little bit worried about the Russians, not quite sure how committed we're going to be to getting rid of these ISIS guys. And then that's what the market just shows, a confused state. Is it probably a buying opportunity for stocks? Probably. But I haven't sold any put spreads or anything like that yet, mostly because I'm surprised by the action. I was much happy to get on the ride if I saw it, but I'm going to hold back a little bit. So at least not going to add.
Yesterday on the option block, you were calling for exactly what we got today. You were predicting and prognosticating for the Jets going in and that perhaps restoring some stability to the market, and exactly what you're talking about, perhaps a bit of a rally coming back and perhaps a bit of a vol crush in the wake of that. And you're right, the Jets went in today, and so far we're not seeing that. Maybe some of that also is due to a bit of the different nature of what they're dealing with over there. It's not exactly a state actor where you can go in and send a couple of jets and, you know, that kind of takes care of it.
And
these
really
guys
hurt them.
Yeah, these guys are kind of spread out through the populace. It's a different beast entirely. That probably plays into a little bit too. This is a different type of threat.
All right, so we're getting half. We're getting a little rally, but no vol implosion. It's like aliens versus monsters. You know that blob guy? What was his name? Bob? You know, you stick your hand in him, and he just sort of, hey. That's kind of what these ISIS guys are, I feel like, you know? They're like the blob guy. You can't get rid of them. You know, you cut them in half, now there's two of them. It's like, come on.
I think that's the best analogy I've heard for that entire situation so far. He is Blob from Aliens versus Monsters. I love that. That's great.
The show has a new title.
The Blob of the Middle East. Jared,
you've got to help me here.
Save us.
Into a hole.
Save us from this terrible, terrible place we've been dragged to by the rock lobster here. What was your take on the week that was from a vol perspective?
Yeah, let me take the other side of it. Not because I disagree with Andrew, I don't, but just for at least for the intellectual satisfaction of it. Think about it. Let's put ourselves in the shoes of a long-oriented equity investor. You're trying to figure out what the market is worth and how to balance the good earnings we have with the risks that we see. And I was thinking about this morning that, you know, when you've got one geopolitical kind of risk scenario that's playing out in some kind of a familiar pattern, just as you say, Andrew, I think we know how to deal with that. We know what to expect and how other market participants usually react. When you have multiple scenarios, when you've got things going on in Iraq, the standoff in the Ukraine, the kind of will they, won't they continue aspect of the conflict with Israel. And I think it's harder to assign a value when you have, you know, multiple things going on at once. Like, you know, the difference between juggling one ball and three balls, it's just significantly more difficult. And when you kind of put that in the context of this broader picture in the U.S., where not that anyone's concerned about the rates environment changing soon or about the Fed exiting, their sort of unconventional policy in an aggressive way soon, but you have people trying to rotate out of the asset allocation frameworks that they've been in for the last several years into something that's going to serve them better for the next several years. You kind of mix all that together, and I think that it makes for a kind of a model that isn't nearly as straightforward as the kind of markets that we saw, you know, maybe 6 or 8 months ago. And so for that reason, it's kind of, I can kind of understand why volatility has been bid this week and last week and why it remains so. Even out there in VIX options, you see a persistent premium that's kind of stuck around a little bit longer than we might have expected, given the relative price moves in the underlying equity indexes.
Well, let's get into those aforementioned VIX options. Then we talked about some crazy activity in the VIX cash, VIX futures trading all over the place, including at a bit of a surprising discount you might expect this week. And the VIX options also trading up this week. A little bit off of the heights we've seen recently, particularly when you're talking about indicators a lot of people like to look at, like the call to put. VIX coming off the highs, it got up to, I believe, 3.8 at one point, getting close to 4-to-1 calls to puts out there. VIX always call heavy, but that's getting pretty ridiculous even for this name. It's starting to lighten up a little bit. You can perhaps advocate that some of that is due to the fact that we have rallied a bit in the underlying over the past few weeks, and that gives a few more strikes to the downside so you can actually play in a few more puts. Wherever your viewpoint lies on this, it is coming off a bit, about 3.4-to-1 out there. Calls to puts, looking at the hot strikes where all the action is, the most love out here in VIX land right now. And Aug, finally, after a long time with Sep at the top of the charts, Aug finally taking its rightful place here at the top. Given all the near-term action we've seen, you'd think Aug would have snuck in there earlier, but c'est la vie, Aug taking the top spot. The Aug 16 calls to be precise, with about 275,000 roughly open on that strike, gaining another 7,000 yesterday. So a lot of love in those. Then we move back to September right again with Sep-19s and Sep-21s. Those Sep-19s have always been the strike du jour, it seems like, since we've started looking at these again recently. About 262,000 open to those, and then the 221,000 of the Sep-21 calls. And again, this is all calls all the time this week. Next up, Aug 20s, and then Sep-20s, all about 200,000+ contracts, and then the Aug 15, 17s, followed on the heels of the Aug 25s and Sep-16s, all at 200,000 or a hair shy of 200,000 in open interest. So no puts on the big board this week, which is not exactly surprising when you look at the net open interest out there. We've also talked recently about the short-term VIX, that is the VXST. That's a product you'd think would be getting a nice tailwind in the recent weeks, given all the near-term action we've been seeing, and people would be piling in to a product like that to take advantage of what we've been seeing. And the answer to that, I guess, is a bit of a yes and a no. We saw a nice spike in open interest recently. It's since come off a bit, but we're still much higher than we were. We were averaging in VXST somewhere around 1,200, 1,500 contracts for quite a while after launch, and the ADV was around about 500 contracts a day or so. The open interest is now still higher. It's about double that, about 3,000 contracts right now, and the ADV has crept up to about 800 or so contracts. Still off the highs it set recently, about 4.2 or so calls to put. So when you're talking about heavy call interest, VXST is leading the charge. A lot of call love out there, not surprisingly, given the nature of this product. Not doing a whole heck of a lot today. Only about 30 contracts going up so far today. We'll see if that changes. This is an interesting product. It has fits and starts. People love it. People love it. People don't touch it. People love it. People love it. So it's an interesting product. I think we need to see a little bit more time to see how this thing kind of plays out. Jared, were you surprised that this product it's done well, don't get me wrong, but it hasn't really captured a lot more share in the recent weeks, given all the near-term vacillations we've seen in vol? This would be an ideal time. You'd think if you're going to embrace a product like this would be an ideal time to do so.
Right. I agree. I think my working theory is that when you see a move like we've seen it higher in implied vol that isn't really matched by an increase in realized volatility, it doesn't shake the right kind of trees. I mean, it doesn't get people, the people who would be most inclined to be buyers of volatility products right now, aren't, I think, going to be on board when the market is still relatively quiet. So, we talked about this a little bit last week, and without some kind of real big move in S&P realized vol, I mean, we're still right around, I think, 11% or so on a 1-month realized basis. I think there's just not enough motivation to get people into some of these products that have a shorter term focus.
Andrew, has VXST started to capture the attention of any of your mentees over there, or is it still a little bit esoteric for them?
To be honest, we look at it, the liquidity just has not, I guess the short answer is we watch it, we have not got excited or really done anything in it as yet. It's just, it's there, it's interesting. I like looking at it, but we just haven't, I tend to only trade the VIX when I have some severe dislocation in the futures. I'm not like a daily VIX trader guy. And I've been too wrapped up when we just did some looking at the VIX normally to dance over and check it out. So it's just not on my radar screen yet. It will be at some point, it just has not caught me yet.
I think that sums up the way a lot of people feel about this product. They like looking at it. It's interesting. They're glad that it's there, but they're not really diving in with both feet yet. It's kind of the old chicken or egg thing for any new product. They wait till the volume comes, and the volume doesn't come because everyone's waiting. So it's kind of that catch-22. We'll also take a quick wrap up here, a quick look at our friends over there at Russell and the RVX, see what's cooking over there. Not a whole heck of a lot since the last time you looked at it, listeners. The open interest, a lot of that has expired, and they're kind of waiting to put on some new open interest. In terms of call heavy, about 5-to-1 RVX calls versus puts. So again, all these vol products are traditionally upside heavy. That's kind of just the way they roll. But on top of it, some of these other products like VXST and now RVX really seem to be exploring the depths of how call heavy you can become. I know for a while there was not a single contract of put open interest in RVX. It seems to have changed a little bit. There's 100 lot of the Aug-14 puts open right now, but not a whole heck of a lot of put love in either of these products, which is interesting. I mean, we talked last episode I was on at least, about straddles going into earnings. We are still in the teeth of earnings season, so there's a lot of interest in this topic. A lot of you guys, thankfully, wrote in with some interesting ideas on this, including a few of you sending links to, we talked about the Goldman Straddles study on the last episode here that I was on, and a lot of you wrote in saying, hey, have you talked about this one? Have you seen this one? Including our good friend Don Schlesinger also sent it in. Yes, Don does still listen to the show every week, listeners. So he's staying tuned to what we're talking about here on Vol Views, and he sent it in as well. And this is not an earnings study, but it's a related study. Goldman also did a study on analyst days. Talk about earnings being understudied. analyst days is far less evaluated even than earnings, which is, I think, why they dove into it a little bit. And they did kind of the same analysis they did for earnings on the analyst days. They studied 3,700 analyst days from 2002 to 2012. And they found that on average, return-wise, it was twice as positive for stocks versus the average day, these analyst days. So already you're getting some good movement. And they all found some other things that it's more positive for the stock if the analyst day is held farther away from earnings than if it's held closer. That makes intuitive sense. You've already done a lot of the analysis work if you're near the earnings event. If you do it closer to it, it's not going to have as much of an impact. Farther away, it's more of a standalone event. But what's more interesting, I think, to us here on this show and you guys listening is when they start breaking it down in terms of options and vol. And they found that overall, options tend to underestimate analyst day volatility. And they found that call buying ahead of the analyst days resulted in a 22% return. We were talking about straddles before. Straddle buying also did well because, again, that vol was underestimated by implied volatility in the marketplace. The straddle buying returned a net 5%. So vol underestimating the impact of these analyst days. Don't sell premium, buy premium clearly, and you're going to do fairly well. And when they compared the results of the analyst day studies to their earnings day studies, they found that it actually was a bigger bang for your buck looking at the analyst days. They found that vol was more dramatically underestimated going into analyst days than it was into earnings. Again, that makes sense. A lot more eyeballs around an earnings event than there is around an analyst event. Call buying profit ahead of the analyst days was 22% versus 13% in the earnings study. And the straddles brought back about 5% on the analyst days versus just about 1.5% in the earnings day studies. And they were also doing some delta neutral call buying that worked out to be about 7% return. Again, that's buying the call, obviously selling stock on a delta neutral basis. So this is kind of an interesting corollary to what we were talking about on the show a couple of weeks ago. Jared, have you had a chance to look at this? Is this study familiar to you at all?
No, this is the first I'm hearing about it. So I'm kind of listening with rapt attention. You know, my instant reaction to this would be if I wanted to think about why this might be plausible or even intuitive. If you think about where investor focus is in a given quarterly cycle, everybody's focused on earnings. It's a real publicized event. There's even at the level of infrastructure, you know, there's a lot of technology and you know, in terms of our brokerage platforms and who's looking at what. Everyone's focused on the data coming out during earnings, what those numbers are going to be. You get, you know, instant reactions in the aftermarket as soon as that data pops up in someone's software. So I think the level of focus around the event and the anticipation that drives volatility higher, implied volatility higher ahead of earnings, just isn't there at all around an analyst day. And so to the extent that there's still some information that comes out to the market of fundamental value in those kind of events, in the absence of such widespread investor attention, such relatively less infrastructure in terms of our trading technology focused on those days, it would kind of make sense that you might see a greater return net of, you know, volatility. Maybe, I don't know, you know, what the actual return is in terms of stock returns on a comparative basis, but it would be totally intuitive if the options return was better, simply because you wouldn't have the same kind of inflated premium ahead of an analyst day that you would have ahead of earnings, if that makes sense.
Yeah, you know, for all the complaints we had recently about options and straddles not being studied well going into earnings events themselves are very highly scrutinized events. So there's a lot of research, a lot of data, and a lot just more focus. So you'd expect the overall market consensus and the options consensus to be a little bit more accurate around those days versus not as accurate when fewer people are watching. So take advantage of that, I suppose. I'm looking here at the methodology while you were talking. They mentioned the delta neutral call buying. They don't mention if they're dynamically hedging the straddles and that's where that return is coming from, or if it's just on a pure return, pure movement basis. Of course, if you dynamically hedge these straddles, these numbers can change dramatically, but still interesting stuff. So if you're looking at how to lean going into perhaps not just earnings, but actually analyst days, this is some good fodder for you listeners. I encourage you to check this one out. Andrew, does this one resonate with you at all? I know you're a big proponent of buying some juice ahead of earnings events and then scalping that gamma aggressively and then closing out the position. Are you going to start adding analyst days to your buying juice calendar now as well?
Well, I have to admit, we do look at that. I think I'm much more of a fan of the analyst days, like after the analyst day is sort of over, selling the volatility kind of after the analyst day. I think it's probably similar to earnings where you can make a little money sort of buying into it if you're able to sort of be able to buy some premium. Mostly I like buying premium into any event that is going to hold up the decay. So yeah, I mean, that I knew. I'm glad Goldman did a really expensive report to tell me what I already knew after trading it 500 times. But it's good to see that. It's my belief in general that I think realized volatility, options underprice volatility a lot because options do a poor job of pricing a one-day move. They're great for long-term stuff. That's what the model's for. But I think that they underprice a lot of really sharp short moves a lot of the time. So that's my little secret. I'm going to keep it, and nobody is allowed on the show to listen to it.
I am looking here again, and it looks like they are delta hedging the calls, but for whatever reason, they're just letting the straddle fly high. So it's I think they say they buy it 5 days before, and then they close it out 1 day after. So that's just a net move that they're calculating that profit. I could see that's a little bit easier to do it that way, and from a calculation perspective and a research perspective, than trying to dynamically hedge all those positions and then calculate that. But still interesting stuff, listeners. If you're looking for some information on this, this is certainly an interesting one to do. I do also love as well, maybe Jared, you have these glaring disclaimers in your research as well, but Goldman has an interesting one here at the bottom of the first page. They say Goldman Sachs does and seeks to do business with companies covered in its research report. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this report. So essentially they say in the opening paragraph here that they are complete hucksters and they will try to sell you under the river any way, shape, or they can.
We will hose you.
Yeah, it's right there in the first paragraph. This is complete and utter garbage. I love it. It's fantastic. We will tell you whatever we want you to hear.
I'm not going to speak on behalf of any other organization, certainly, but I can tell you that there are some organizations in which there's an extremely tight wall between equity research analysts and trading desks and others, and that some organizations are extremely careful to protect the interests of their clients.
Well said, sir. Very political of you. All right, and moving on to some other topics here in the old Vol review. Jared, this was your suggestion, actually. You found this one. This comes from our good friend Russell Rhodes over there at the SIBO. He's been on the show many times, works for the Options Institute, does a lot of volatility research and a lot of options research in general. And I guess he has a little bit of a pet project he's been working on here. Keeping an eye on some of the put rights that Warren Buffett infamously did recently. You may have heard Warren Buffett, of course, describe derivatives as financial weapons of mass destruction. Listeners, that, of course, doesn't stop them from employing them on a regular basis. And very famously, at least for a lot of people in the option space who remember those comments and took a lot of umbrage of them, they noticed that they were also selling some sizable index put positions. This was back between 2004 and 2008. They entered into what they refer to in their annual reports as the quote-unquote equity put trade. They sold over-the-counter put options. They expire in about 15 to 20 years in a variety of indices, a lot of S&P, but also Euro Stoxx 50, the FTSE 100, and, of course, the Nikkei 225. So they wrote puts across the board. They were pretty much out of the money, at least at the time that they wrote those. And these have been controversial for a number of reasons. First off, of course, that Buffett is diving into derivatives after famously lambasting them and saying they were terrible. He's now using them, which is interesting in and of itself. But also for a lot of the, shall you say, questionable accounting of these positions as going forward. Of course, derivatives, particularly OTC products, have come into a lot of scrutiny post the 2008-2009 meltdown and the resulting Dodd-Frank regulations. So seeing the way a high-profile firm like Buffett's accounts for these is pretty interesting. And Russell Rhodes over there at the SIBO wrote up an interesting blog kind of looking at the way these puts have been handled over time. He wrote that back in 2007 shareholder letter, they wrote that the put options brought in $4.5 billion, that's billion with a B, listeners, in premiums, and they were European style, due to expire between 2019 and 2027. 1 year later, in 2008, it was noted that the notional value of these put options totaled over $37 billion and were written on the 4 major indices that we talked about earlier. And then due to the drop in global equity markets, the valuation of these puts became a liability of $10 billion. Again, you're writing puts, the market drops, not a favorable scenario in a lot of those circumstances. And they had a mark-to-market loss of $5.1 billion. In 2009, they disclosed that the terms of about 10% of the contracts had changed. They rolled the strike prices down, gave up some time. However, they also noted that in these modifications, no money changed hands. Must be nice to be Warren Buffett, Andrew, you could just roll and adjust all day, and it costs you nothing.
I guess. I mean, what I'm assuming is that, the vol had come in and he's taken advantage of it by rolling the strikes down. That's how I kind of read that, unless I'm wrong, right? So he's just starting to he had the big balloon, vol came in, some of the put value came in. He's like, yeah, okay, I'm going to roll this a little south so we don't get screwed again.
I read it as Buffett called up, says, hey, I want to roll these. And they said, oh, okay, we'll do that for you. And we'll just match it up and it'll cost you nothing, because that's Buffett. He put them on at a ridiculous premium. Remember, he wrote those puts in Goldman Sachs right after the teeth of the meltdown, and they paid him a ridiculous amount to do it. So they do carry a little bit of weight when that phone rings.
They do, because he can usually write just the $10 billion check like relatively easily. Like you write a check for your phone bill. He's like, okay, here's $10 billion. Boop. So impressive. I do have an anecdotal story for derivatives and Warren Buffett.
Let me 1 second before you get into that. Let me just finish up the rest of Russell's rundown. Then we can dive into your anecdotal analogies here. In 2010, this is again all Russell's analysis. So check it out on the cboe.com website. You can read the whole thing. In 2010, they received $647 million for selling those puts and paid $425 million to get out of those obligations, resulting in a net profit of $222 million. That left them with 39 short equity index put contracts on their books at year end. 2011, the book value of those positions was a liability of $8.5 billion, determined using the Black-Scholes model. Very fancy. And then in 2012, those liabilities had dropped to $7.5 billion. And then in 2013, the put position open short had dropped back to $4.66 billion. Mr. Jared, before we get into Andrew's anecdotal tale, I know this caught your eye. This is a pretty interesting story. It's been very controversial. A lot of people disputing the way they value these puts, because clearly they should have been marked very aggressively against them, particularly into 08 and 09 in that time frame. What's your take on all this back and forth on Buffett put writing land?
Well, there's a really interesting theory about these puts that the most recent data from Berkshire kind of impacts. So Pablo Triana, I think, was the first person who noticed this. He's a fairly well-known academic in Europe, and he has a lot of derivative experience. And he found a document from Lehman Brothers detailing a trade with Berkshire Hathaway that looked very much like the one we're discussing. But the difference was that this was a trade using worst of puts, which is a kind of an exotic option structure in which the short put position that Buffett has on would be linked to the worst performing indexes out of the 4, out of the S&P, the FTSE 100, Euro Stoxx 50, and then the Nikkei. And so the reason this is so interesting is that it makes Buffett's payoff contingent on which of those does the worst. And given the performance we've seen over the last year or two among these different indexes, they haven't all moved in tandem. So, right, the indexes in Europe and in Japan have fared particularly worse. And the evidence that this was at least part of the transaction that Buffett had done, certainly Lehman Brothers wouldn't have been the only counterparty, but the evidence was there that it seemed to indicate that he had done at least a little bit of this type of a trade. And so this has been a kind of running theory, at least for the last several months. The evidence against the view, which just came out lately, and I was talking with Russell about this, was that Buffett's liability on the position, as reported in the 10Q, did not increase as much as we would have expected it to if he did have this sort of worst of position in place. Because the Nikkei has done so poorly this year, we would have expected the value of those puts to move against him to a greater degree. And so it looks like this latest 10Q amounts to some evidence that, in fact, these might just be individual vanilla puts on the indexes rather than a kind of a basket in a worst of type of a structure. which is something, maybe it's not, I don't know how broad the interest in that is, but I think trying to uncover precisely what Berkshire has on, given the size of the transaction and the profile, I think is always a kind of an interesting parlor game.
So I have a slightly, so I've heard that, Warren Buffett, derivatives are weapons of mass destruction. However, I was a young trader, this was early 90s, like 91 on the SIBO, or early 92. And there was a client that started selling puts in Coke. Now, I don't know who it is, so I can't say it's Warren Buffett. But they basically sold position limit in almost every strike, selling puts in Coke, and single-handedly demolished the implied volatility in Coke, which in turn demolished the implied volatility in the S&P 500. So I guess when you say derivatives are weapons of mass destruction, usually only when you're on the other side of one of his trades, because he single-handedly demolished, I think anyway, or somebody who had about $1 billion to spend, or $2 billion or $3 billion, whatever it was, to get super long Coca-Cola. Now, I don't know who the biggest shareholder in Coca-Cola is, but I think that's where they got their start. So I'm just finding that a little humorous on that score. So that's and that was, I think he pretty much sold the bottom of the market right after that. We had that first savings and loan crisis, if you remember about that. That was like 2 crises ago. And he was just there in size. So the guy's got obviously an awesome track record of pretty much buying the bottom and getting paid to do it.
Yeah, there are worse ways to make money. But yeah, you're right. That does sound like his MO, and a name he certainly is famously involved with.
Not saying it was him, because I don't know, but it sure was funny how it happened.
If it looks like a dog and barks like a dog, then perhaps it might be a duck. All right, interesting stuff. Interesting stuff. There are, of course, other things going on in the world of volatility, other asset classes moving. We talked at the top of the show about everything going on a macro perspective, a global geopolitical perspective. That, of course, is going to come back most dramatically in some of the classes, like the energies and, of course, the metals. So let's dive into those before we hit on some of the listener cues. We got a very interesting one coming from some of our listeners here today. But before we do that, Jared, I know you watch, of course, the energies, the crude, you watch the metals, particularly the shiny stuff. What caught your eye out there in a vol perspective amongst those asset classes?
Well, it's been a kind of a slow bleed in oil after at least in WTI got up to around 20%, at least intraday in the OVX index back in early August, and it's come in since then. We're now like a little bit below 19, but it's been a kind of a slow move lower, and I think that's probably for the reasons we talked about at the top of the show. When you have these different geopolitical risk scenarios all in play, all of which are going to conceivably have potential impacts on energy, and at least in a regional sense, it just makes it harder to price short-term options on energy products. And so I think that's why you've seen this kind of steady churn sideways, more or less, in oil implied vol over the last week. In gold, the move has been less dramatic, but gold implied vol, talking about the GVZ index that a lot of people look at, was down around 14 several sessions ago, and it's been creeping a little bit higher since then, but still really well within the range that we saw for most of July. So that's a little bit less remarkable and familiar. And otherwise, I think there's some tail kind of things that people have been talking about this year: the prices of food, the drought in California, and it's interesting how the fact that Russia recently sanctioned food imports from the United States, but given how tight the supply has been for poultry and meat this year, there's nobody really expects that to have any impact at all, on the margin, because of the domestic drought conditions that we've already seen. So there's not really as much of a story there as we might first think.
Yeah, I thought today's events would have had a little bit more impact on an oil vol in particular, and we're not really seeing that much of it. Of course, OVX is a bit of a mixed beast. That, of course, listeners, is the VIX being essentially applied to the USO, which is that much maligned oil ETF, and that's a very broad-based ETF. So there's a lot of other factors at work there driving OVX. Nonetheless, it's still an interesting indicator to look at. Andrew, I know you are one of those people who frequently maligns USO. Any of these developments out here in either OVX or GVZ or anywhere else in the vol spectrum catching your eye this week?
Commodities. The only we watched oil. What's remarkable to me is I think how much has changed in it, because anytime there was Middle Eastern stuff, remember the Libyans a couple of years ago? I mean, volatility spiked to like 50 or 60 or something in there.
Yeah, it was a serious move.
And now, I mean, literally you've got terrorists, whatever they are, the ISIS guys, like bearing down on oil fields in Iraq, and nobody cares.
Yeah, we have jet fighters heading to that region right now, and it's ticking off a nickel as we speak.
And volatility's like down a tick. So clearly something's going on in the oil market that ain't what it used to be. And I think that big part of it is, the U.S. is, or the way that we're pumping oil into, we are kind of like sort of the 10-ton tank now. And, there's maybe some fundamental changes going on in the oil market. So I think that's all good. But it's definitely a different market, and we're just not getting the volatility we've seen, mostly because we're going to be, or soon to be, a large next exporter of petroleum products, either hopefully natural gas next year or the year after. But at the very least, we're pumping an awful lot of oil, and I think it's just changing the balance. I think it's another reason to be, kind of closetly bullish, because we have some oil independence, but it's changed. I think it's changed that. I think that oil market at least has changed for the next 3-4 years until something else happens. But definitely a sea change.
Andrew, I think it's okay. Andrew, if you want to come out of the closet as a bull, I think that's okay. Given the state of the economy and the data, let your flag fly, my friend.
Yeah, I mean, who would have thought that in 2008, we'd be relatively energy independent when oil was like $200 a barrel or something. It was like looking ugly. The government's deficit's decreasing rapidly. They're arguing about the same stuff they've always argued about, and there's a lot of slack in the economy, but it's just, and I think just one of the things, like another anecdotal thing, is there isn't that vol shock in the oil market anymore. So, when you have jet fighters flying into a major oil producing country and it's not moving the needle, USO today is, let's see where it is. It actually is not blinking, so it's unchanged. It's so unexciting and such a piece of junk that it's down a tick. It's down a tick now.
Yeah,
so
that's incredible to me.
It's freaky. So, you could go broke buying juice in USO. I think put time spreads have been good, but other than that, it's about it. Out of the money, put time spreads is about it for me.
All right, all good stuff. We can keep debating this stuff for a while. There's a lot to debate here, but I want to make sure you guys get your turn here on the old panel too. So it's time to open up the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome back to the Volatility voicemail segment. This is, of course, the portion of the show where you guys get to take the reins and let us know your questions, your comments, your insights here. We got a great question here from a listener, Ruben Brooks. He listens to all of our shows, writes in. Those are the kind of listeners that we certainly love here on the network. And he's doing what I recommended you guys do at the top of the show. He's checking out some of the archives, and he had an interesting question about one of the shows we did. He writes, I listened a while back to a show you and Jared did talking about Nassim Taleb and how you were surprised that, given his long gamma leanings, he would short the at-the-money straddle. I found his interview he did a while back. I would be curious on your thoughts. And listeners, he's referring to a show we did, I don't know, probably about a year and a half ago, would you say, Jared?
I remember that show.
Yeah, that was a fun one, Jared.
Yeah, I think that was about maybe a year and a half.
About a year and a half ago. I'll have to dig up the exact number later. But Jared came on as a guest. He wasn't co-hosting with me yet. And we discussed this exact fact because listeners, if you know anything about Nassim Taleb, you know he's famous for his black swan pronouncements. And you would assume that a guy like that who's always saying the market underestimates these extreme Six Sigma moves and doesn't price them in accordingly would be long up the wazoo of out the money premium and long gamma just in general and long premium all the time. And what we discovered and the thing we debated on that episode was that surprise, surprise, he's not. He's actually shorting a bunch of at the money premium and then buying out of the money premium. And he's using that short to pay for it. And that, I think, struck a lot of us as mildly at least disingenuous, because what he comes out and says to the mass market all the time is that these things are undervalued, you should be buying them, and yet he doesn't really reveal the way that he actually pays for this over the longer term. So we had a nice debate about that. I encourage you listeners to go check that out. But the link Ruben sends in is actually from reprinted from Active Trader magazine, interview they did with him back in 2006. And what's interesting about this, Jared and Andrew, is this is one of the first times I've ever seen Nassim actually describe and discuss this in a little bit more detail. And there's a lot to go through here. I'll just hit some of the highlights. They say here in the article, unlike many options traders who collect premium from selling out of the money options, Taleb focuses on buying far out of the money options that have a low probability of making money but post extraordinary returns if they do. He says he first realized long out of the money options can produce unusual returns after he began trading currency options for International Bank back in 1984, and he made a very sizable profit on that. He says, here's one thing you can learn from this. If you owned an option that was 20 standard deviations out of the money, and I had plenty of those, he says, how many cumulative months of time decay could you sustain if it moved into the money? And the questioner says, I don't know, a few dozen. And he says, no, I quizzed traders, and they were telling me 2 or 3 years, but it was 67,000 months of time decay. You get paid 67,000 times your bet. It means you don't need the event to happen often for you to be compensated. You don't need to be right on the event because you can bleed for 67,000 months straight and still be ahead. After the crash, I told that to my management at Credit Suisse, and they told me to essentially go take a hike. And that's the traditional narrative you would think of Taleb. He's loading up on these puts all day, and that's about it. But this guy actually goes on to ask him, but meanwhile, you could sell near the money options. And Taleb says, yes, but it's a lot of work. Now I have an economic interest in other traders through his Empirica fund that sell near the money options. And he says, if you want to place butterflies in 500 securities, it's a lot of work because you have to adjust them dynamically. We've talked about dynamic adjusting and hedging a lot on this show, listeners. He goes on to write, but if you buy strangles in 500 different securities, it's a no-brainer. He goes on to say, if you care about performance, which I would think most people would, you should short at the money options, which expire and have very unstable deltas. Sometimes they bite you at expiration, so you have to monitor them. The amount of labor involved in strategies that have both long and short options is astronomically higher than just buying the options themselves. He says, we invest in traders who sell at the money options, and we concentrate on just buying the wings, the out of the money puts and the calls of the butterfly positions. So there you go. That's how he describes it a little bit. He still is focused on the premium buying end of the fence, but he backs a bunch of guys who apparently sit there all day and just manage his short theta position. Jared, what's your take on that? I know you and I had a very interesting back and forth on this a year and a half ago. Does this bring us all crashing back to you?
It does. It also makes me a little bit nostalgic, and the reason is that the Taleb of like dynamic hedging, that book certainly, and even a little bit Fooled by Randomness. I mean, you said this interview, it's like from 2006. So this is like before the media monster and
before Black Swan.
And just I feel like I'm not a real close student of the guy's career, but I feel like there's two periods here. There's a period where you have someone interested in the markets and in thinking through what's going on, and then you have a late period, the current period, where it's all kind of pseudo philosophical aphorisms. I mean, I have a little philosophical training, and I can recognize sophomore level work when I see it, and I just prefer strongly the early period stuff where you've got some. Testable claims and worthwhile analysis. And this interview, I think, falls into that former category. Even if I don't agree with the position and the strategy he's describing, it's at least something, worth discussing. And on that point, the I guess the tone here, I think, is a little bit more honest about the implausibility of some of these payoffs. Something that I think a lot of traders after 2008 got suckered into without really thinking through the long-term implications. I mean, he admits at one point in this interview, what was the quote? So I don't know whether these extremely out-of-the-money options are over or undervalued, he says, but look what can happen. A single large deviation can make you right, but 750,000 months of no deviation can't prove you wrong. I mean, that's a really striking claim, right?
Yeah.
Oh, if we sit around for like 62,000 years and nothing ever happens to prove us right, we should just continue on doing the same thing, even if generations after generations pass and nothing ever goes our way. We should still keep buying, those options, keep buying the tails. I mean, I think that's a little bit implausible at the level of human agency and even human institutions to ask people to basically roll the dice on their entire career that at some point something really terrible is going to happen. And it may be that there's some fundamental disconnect between probability and human behavior and our institutional design and career risk. But for practical purposes, I think that a lot of the people who read his work, saw him in the media, and said, oh, I'm going to go around and buy some options. And to say nothing of all the kind of hucksterism around hyperinflation that he got into and all that kind of stuff. I think a lot of people weren't really prepared for the sort of extreme nature of this kind of attitude toward markets.
Yeah, I had almost the exact same response to this when I first read it. I said, wait a minute, this doesn't seem like the black swan hyping, pushing guy that we know now. That's why I went and checked the date, and I said, 2006. This is a different era of the Talib than we know today. Now Black Swan has become a brand. You can buy it on T-shirts, for God's sakes. So it's a different beast. He has a little bit of a different mentality. But you're right. People who are just surface devotees of his, I guess you can call it a philosophy, of his investing strategy, whatever you want to call it, they're probably going broke at this point because they've just been loading up on these puts all the time. Without probably getting into the little bit deeper. They certainly don't have an army of traders managing their short theta for them all day. Their short premium all day. So interesting stuff. Andrew, what's your take here on Mr. Talib and his many, many nuances?
I'm just glad he's around. I think he's good for the show. There's a lot of people that have been long, that have owned options, and ultimately, really what happens is probably once every 8 years, something bad happens. It's been happening for probably 200 years. We've had, I'm a student of financial history. We've had financial crises in the 1800s. We've had them in the 1900s. We've certainly had our meltdowns in the, and what are we in the 21st century? We've actually had two good ones already. So, yeah, I think if you can afford to buy premium and hold it for 10 years, it'll end up paying. It's just, you're going to have some pretty dark years in the meantime. So, unless you have that battery of guys trying to scalp your theta for you, you're going to have some really, really dark days.
Yeah, I guess the message is if you can't employ an army of professional traders to manage your short premium, maybe the strategy is not for you. But Ruben does go on. One other thing he writes, I was very intrigued by a show you did a while back with Chris Cole over at Artemis Capital. I was fascinated by his papers and his exploration of volatility arbitrage. Do you have any resources or books you could recommend where I could learn more about this? I really appreciate all the work you do. You've been by far the best resource and aggregator of resources regarding options education that I have found. If you end up addressing any of this on your shows, let me know so I can make sure I don't miss them. I try to listen to Volatility Views, Option Block, and Options Bootcamp. Thanks for your time. Well, Ruben, you guys are the listeners we do this show for, so we want to make sure we're glad you guys write in and have some great questions, great comments, and glad you're getting something out of the show. And that is a great topic. We've done some great shows with Chris Cole and a bunch of others in that vol arb space. There's a lot of cool research out there. You said you've already read Chris's research on his site, so I won't direct you there. That would be the first place I would send you. But I know, Jared, you have a lot of weighty tomes on your desk that cover the vol arb realm. What are some of your favorites?
I think the papers are the place to go. There aren't that many people who would discuss this in a book length format. I think Ewan Sinclair's stuff has some relevant material in maybe in his books, but there's a lot of papers on this general topic, and maybe it helps. I think volatility arbitrage as a phrase can mean a couple different things. I mean, you can talk about trading implied versus realized vol. You can talk about implied vol term structure. You can talk about volatility skew. All sometimes discussions on those topics fall under this label, and so it's helpful to be a little bit more precise. But there's a lot of really good work in both from industry sources and in academic sources. And one of the best places to go is the Social Science Research Network. It's ssrn.com, and change your search terms. There's a whole wealth of stuff to find on there, and that's all free.
Yeah, that's all good stuff. You're right. Ewan has some great books. He's been on the show too. I'm sure probably you've heard him already. Ruben, but if you haven't, search for EUAN Sinclair, SINCLAIR. In our archives there, you'll find those episodes. He just came out with a new book recently, actually, so you might want to check that one out as well. A lot of good stuff. Speaking of good stuff, we had an overabundance of it on today's show. We're running a bit long, so unfortunately, that's all the time we have for the Volatility voicemail. It's also all the time we have for this episode of Volatility Views. But before we go, really quickly, let me check in with each of my cohorts here, see what they have cooking that may interest you until the next time we all gather here together around the old Volatility Views panel. Perhaps we'll mix it up again. We'll start with you, Jared. What's cooking in the land of BGC partners?
We did a report this week that I'm thinking about making a regular, a recurring theme that I'm pretty excited about. You've probably seen in the news all the stories about companies buying back their stock. This is something that's become a big trend over the last few years. And the performance of companies that are buying back stock is, I'll just say it's notable. And so we started looking on a weekly basis at announcements of companies that are beginning new programs or ending old ones or changing existing programs. And when you combine that with what's happening in their options markets, I think it's a fruitful place for study for traders. And so that's something that we've started doing lately, as well as some really notable activity in equity index vol skew over the last several weeks, looking at some opportunities there as we hit, in some cases, multi-year highs in implied vol skew. And so listeners can get in touch to check that out.
And I see you cashed my check for $5, so I'll be expecting my quarterly straddle study on my desk anytime now.
Right.
Get right on that, sir, as soon as the show is done. All right, Mr. Andrew, what's cooking over there in the land of the pit?
Our rapidly filling boot camp next week, August 13th, 14th, and 16th. So that's a Wednesday, Thursday, and a Saturday. It's about 8 hours of stuff. And for this guy, Ruben, who is looking for vol arb, got to learn what volatility is. That's what we teach. We teach the stuff that we actually did as floor traders, and what we just do now as off-floor traders. So if you want to learn about vol arb and what it is, that's the place to go. We actually have some people that have lived through it, have scars of doing it the wrong way early and learning quickly how to do it the right way. So that's what, but the boot camp will be a little more basic than that, but it will introduce you some concepts that might help you, farther along down your education process. So that is our big event. And I will be at the Money Show in New York, September 12th, to talk about the difference between basically flies and condors, and understanding when is a good time for one or either of those trades. That's what we got.
Good stuff. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.